laid off one-third of their Virginia Beach workforce without notice by sending them a mass text message that they had 8 minutes to leave and be met outside by police. Next coupon expiration is August 31st for both financial advice at stackhack.com, personalized financial advice, or those courses on building your wealth with the daily access to Q&A, course member fundamental analysis, and much more. Check those out, link below. Holy moly, it's finally happened. The Jolts numbers have come in deliciously. We're hearing of more layoffs, especially in manufacturing. We've got some things to cover regarding Nvidia, Google, and what this has to do with JP Morgan, as well as touching on, of course, a little bit on Enphase, Tesla, and even Best Buy. So let's just get some of these important things out of the way. Look, this morning we got the Jolts report, and it has the market moving positively. The impact so far is being felt in that we're seeing a steepening of the yield curve. That's what you want. You want the yield curve to go uninverted without pain in the stock market, though usually that doesn't happen. We're still negative 76 basis points inverted. The 5-year break even down to 2.21, 5-year forward still at about 2.34. If you don't know what those numbers are, just think about the closer they are to 2, the better, because that's what the Fed's goal is. But also remember, the Fed in their back pocket has a policy called flexible average inflation targeting. So as long as we're relatively close to 2, they could just say, look, in the decade before the pandemic, we were a little under, and a decade after, we were a little above. As long as on balance, we're roughly 2, we're good. We don't have to Paul Volcker or destroy the economy. It's a way of saying inflation expectations are anchored. One of the reasons they are anchored is because of the Jolts numbers that we got this morning. We had a survey of 9.5 million job openings. Remember, Jolts is the jobs opening and labor turnover survey. It also gives you some insight into how many people are quitting. Usually a higher number of quits is a sign that people are confident in the job market, that they can get another job. But as job openings compress, that confidence usually falls. And what we found over the last few years is that people who were quitting and getting a new job on average ended up making more money somewhere else because there was so much demand for labor. However, that's finally starting to wane. We used to be at a ratio of 2 job openings for every unemployed person. Well, as Nick T has aptly pointed out this morning, that has fallen to the lowest level since September of 2021. We are now sitting at just 1.51 job openings per unemployed worker in America. This number came in, by the way, again, we were expecting 9.5 mil. We got 8.827. If you remember my video this weekend where I gave you a heads up, I said, look, we need a number under 9. That was my goal. I'm like, if we could just get a number under 9, we could finally tell the Fed these darn lagging jobs indicators are finally starting to catch up. And that's exactly what we got. So praise the Lord, or whomever, this is great news. There's still plenty of jobs for people who are unemployed, but we are finally trending in the correct direction. This is a chart showing you the 3-month moving average, so that's why it's not under the 9 figure. Otherwise, it would be over here if it were a one-month chart. And then this shows you the number of job openings to unemployed. This is finally reiterating, as you can see, it's been volatile, but it's finally reiterating the downtrend. This is actually probably one of the best Jolts reports for the market that we've had in quite a while. But it's not just that we need to talk on. We need to talk on what else is happening, because when we start looking around the rest of the environment and the economy, there are real levels of pain. Consider what just happened at Stihl, the chainsaw manufacturing company. They're a German company, and the darn Germans, I'm allowed to say that because I'm German, the darn Germans just laid off 1/3 of their Virginia Beach workforce without notice by sending them a mass text message that they had 8 minutes to leave and be met outside by police. The company total but blamed high inventory and reduced demand for having to essentially reduce labor. And this is actually kind of similar to what we're hearing at a lot of different companies, most notably this morning, Best Buy. So here's Best Buy's earnings call. I regularly go through earnings calls, especially in our course member live streams where we do fundamental analysis every day on real estate and stocks, because we learn really important things. Like, take a look at this. Best Buy says we are still very early in the process and are testing different promotional offers to determine what resonates most with consumers and continuously improve the digital experience. They're basically telling you, hey, look, we don't really know how to sell in this environment, environment. People are buying less than they used to, and macro is very uncertain. It creates headwinds for us, including student loan repayment. And we don't exactly know what's going to happen, but we now expect sales to be even lower than we previously guided at the midpoint. And part of that is because of lower demand across the board, but they are saying, and I put a little outline over here, they're seeing stabilization in gaming, slight pressure on credit losses from credit cards, laptops flat. Back to school was slightly better than expected, so that gives you a little bit of a category breakdown, but still hardship in various different areas. They are seeing disinflation in supply chains. That's where where they used to see a lot of inflation, but they're actually seeing that go away now. Of course, they're still seeing some pressures from like ground transportation in terms of inflation, but they definitely say this is actually a more promotional environment than it has been on a year-over-year basis. In addition to being a more promotional environment, they're getting more manufacturing promotions, which is basically where the manufacturers are like, look, okay, we need to get out more product so we can keep people employed. So why don't we just call up Best Buy and go, yo, look, Best Buy, we'll give you guys, we'll basically sell you the product for less money, so that way you can sell it for less and we can get it off the shelf and we can keep manufacturing. This is actually leading to this quote, which I thought was pretty remarkable. The promotional environment in some cases is higher or more intense than it was in 2019. And then they qualify that by saying, but you're getting more vendor funding, so hopefully that helps our margins a little bit. In other words, like, hey, we're dropping prices, but we're not taking all of the hit, is what Best Buy is trying to say. They're basically trying to say, please don't dump our stock because, we're getting money from other people, so we should be okay, right? Anyway, so the other thing that we want to touch on is what's going on. Google announced yet another AI product this morning, and as is normal when Google announces an AI product, it's usually NVIDIA that does quite well. So Google actually up at the moment 2.2%, and NVIDIA's up about 3%, Tesla's up about 4.4%, and this is to be expected. JP Morgan, for example, expects to spend over $1 billion in artificial intelligence infrastructure spend over the next few years. And I think what we have to remember that's really remarkable about this is who is actually able to spend money right now. And the people who are able to spend money right now aren't necessarily your everyday consumers. They are the enterprise customers, the big banks, the big companies like Tesla that are like, hey, we're going to install this massive rack of NVIDIA GPUs, H100s, because we have the money to spend on CapEx. We can move that money to H100s, get the best data center servers we can for dealing with artificial intelligence, and boom, we win. Consumers don't have that luxury. Instead, consumers are much more like, all right, we're going to have to be a little more choosy. Like, Kevin, give me your real value proposition here for your courses. It's lifetime access to the live streams and future content in the individual courses I might buy, access to House Hack. But come on, Kevin, what else you got for me? Hey, you know what? Whatever you need, if there's something you think that's missing, send us an email at staff@meetkevin.com. A lot of people right now, by the way, are finding the best deal is bundling stocks and psych and real estate 0 to mill, especially since that real estate depth, that price decline we've seen year over year did end up hitting 10 to 15% in some markets. But a lot of markets have already started recovering from that and are starting to go slightly positive. I'm seeing a lot of markets -1%, +1%. So there are definitely a lot of opportunities in real estate. And with my company, House Hack, we're about to be in escrow on our third, potentially fourth wedge deal, each with over $100,000 in equity after repaired, after expenses, after everything, which is insane because, these are just like picking up 20% coupons as you're going around. And this is actually what I teach in the courses. That's because I have an abundance mindset, and I believe that there's plenty for everybody, especially when you're taking properties that are not livable and bringing them back to the market. However, this does, of course, bring up the question of what about Enphase? So Enphase is a really interesting one because on one hand, Enphase is a consumer play as well, right? Enphase relies on an individual homeowner to decide to purchase a product, to decide to install a solar panel system. And unfortunately, right now, most people's ability to finance these solar systems is very limited. Home equity lines of credit are becoming more popular, so that is good news. That's a tailwind for solar. but the interest rates are high. So people who are calculating their break-evens are like, it's harder to justify doing solar because rates are so much higher. Now, this is, of course, leading to some compression in the EPS expected for Enphase. Enphase right now is trading at $127 per share. If we divide that by about the $5 of EPS we're expecting by the end of the year, you're sitting at about a 25.4 times earnings multiple, which is probably one of the lowest multiples we've seen for Enphase in quite a while. But most importantly, we should evaluate the growth still projected by Wall Street. We're looking at next year, 2024, 30% growth. This is really where we're going to get our tailwinds from that Inflation Reduction Act and the stimulus, followed by 29.6%. 11% and 18%. Those are the numbers based on Wall Street expectations. And if we divide those numbers by 4, we'll get an average growth rate of about 22.15. Well, if we take that 25 PE and divide it by 22.15, we're really trading at about a 1.13 PEG ratio for Enphase. If I lost you on that, let's just put it this way. It's really, really low. In other words, appetite for Enphase right now is kind of like what Tesla was when Tesla was somewhere around $110. And this is where it's sort of weird because on one hand, it's like, we want to kind of invest where enterprise is, not necessarily the consumer. But on the flip side, this is like the dog in terms of valuation. Nobody's touching it. Watch this, okay? Let's take Tesla. So Tesla, for example, right now is selling for $250 a share. So if I go $250 and divide them by this year's EPS of $337, Tesla's selling for 74 times. Okay, but we're going to take that 74 times, and we're going to divide it by their growth rate over the next 4 years that's expected. The Wall Street expected growth rate, which we might think it's a little higher, I personally think it's going to be between 30 to 35%, right? But if we take the growth rate for Tesla over the next 4 years, based on what Wall Street thinks it's going to be 28.85. Okay, 74 divided by 28.85, that puts you at a PEG ratio of 2.5, twice as expensive as Enphase. You could do the same thing with NVIDIA or some of these other companies, right? NVIDIA, just to look at it quickly, you're at about a 48 PE ratio right now based on $10.24 of EPS by the end of the year. Honestly, they'll probably beat that. And take that 48 and divide it by about 30% growth, you're sitting at a PEG of 1.6. So NVIDIA is actually a better deal right now than Tesla and Enphase, potentially, unless Tesla can really get their growth rate up. Now, what about Enphase? Is it possible that they don't grow next year as expected? Yes. However, that would assume that interest rates don't come down. So really what you're looking for is if you don't really care about interest rates, you think we're going to have higher for longer, NVIDIA is probably a really good bet for higher for longer because your enterprise customers are going to keep spending. If you think interest rates are going to come down and the stock market needs to start pricing in interest rates coming down, probably some of your best plays are going to be the Enphase and the Teslas of the world, because these are going to have massive tailwinds from interest rates coming down, especially people taking on variable rate loan home equity lines of credit. They'll buy today expecting that interest rates will come down going forward. Now, I'm not suggesting as personal financial advice you should do that. I'm not a big fan of borrowing. I'm not a big fan of people using buy now, pay later or otherwise. But these are all things that people end up using. And so if you personally, by the way, want financial advice, you want to get your personal portfolio analyzed, everything in your financial situation analyzed, we're doing a sort of startup offer in terms of what we can offer you as licensed financial advisors. It's a really good holistic review of everything that you've got going on in your financial life. And we'll give you pointers on how, what basically I would do in your situation as a licensed financial advisor. This isn't, this is what Kevin would do as Kevin in your world. It's what would I do in your shoes as you, right? So check that offering out at stackhack.com. That's obviously different from the courses because this is one-on-one. Check that out at stackhack.com. Thanks so much, and we'll see you soon. Good luck out there.
Congratulations, man. You have done so much. People love you. People look up to you.
Which I say, yes, meet Kevin.
Where does this mean we are in the economic cycle? Should we be thinking about buying real estate? Should we be thinking about buying stocks? I have a background in real estate as a real estate agent, real estate broker, real estate investor, a stock market investor, and fund manager.
Why not advertise these things that you told us here?
We'll try a little advertising and see how it goes.
Always great to have you on. Kevin Paffrath there, financial analyst and YouTuber, Meet Kev.